Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to CEO Jerry Randall and CFO Danny Wells of Venture Life Group, a leading consumer healthcare products firm. So big welcome, gents.
Thanks, Paul.
Thanks,
Good to
Paul.
talk to you again.
Yeah, well, it's great to see you, and particularly given all the sort of strategic developments over the past 12 months. So maybe we can start there, Jerry. I don't suppose you could just quickly remind the audience what's been happening, since really the first acquisition, £10 million on from Health and Her in November last year, and then the transformational disposal of the manufacturing division plus some non-core brands to Biodo for €62 million. So what that means for the company, and particularly in terms of the sort of, whether it's changing your investment perspective.
Sure, no problem at all. So we acquired the Health and Her business in October last year. That's fantastic. That's in a really interesting space of hormone health, hormone support for women and for men. So we launched the Health and Him brand in the autumn as well last year. So that's created a lot of opportunity in terms of new distributors, particularly Holland & Barrett. They have a strong relationship there. So we're now into Holland & Barrett as well. And great MPD pipeline, fantastic team. We've now integrated the teams from Venture Life and Health and Her. So we're all one big team now, and had some great new hires. And then obviously, in the just after the half year, we disposed of our CDMO operations. They've been part of the business for a long time. There was a good opportunity for that divestment. It allowed us to simplify the business, to focus, and we now become a pure play brands company, which operates in a higher margin market, higher gross margins, higher operating margins, but also in higher values and higher multiples. So it's given us a simpler business. We're focusing on the brands. We're investing on them in the UK. With the realization of this cash, we've got the opportunity now to invest more behind our brands. That's the growth in the A&P, and as you would have seen in the announcement, we've been spending more on A&P, and that's delivering good results, good organic growth across our portfolio, but also some selective acquisitions. And we're still quite keen to make some acquisitions into the portfolio. We've got £34 million of cash sat on the balance sheet today. We're also in the process of disposing of our oral care brands, which will deliver some more cash, probably 4 or 5 million of cash into the portfolio. And then we've still got our RCF, which is 30 million committed, 50, so another 20 million on top of accordion. None of that's drawn now. We paid all that down when we sold the CDMO businesses. So that 34 million is our net cash position, and that will grow during the course of this year. And we'll use that and the RCF to make some nice acquisitions.
Yeah, and on that mouthwash, is that Dental and Ultradex?
It is, yes.
And what sort of timescales do you think that transaction might happen?
Yeah, we'd expect that to be done by the end of the year. We're quite a long way down the road. So that's close to being done. And they're not core products for us anymore. The women's, men's health, hormonal balance, that's all areas where we want to focus our business. So it's an asset that's not core to us, so it can go into the hands of someone who wants to focus a bit more in that area.
Yeah, and if that divestment occurs afterwards, does that leave you with a sort of 100% of your revenues now being your own brands?
Yes, that's correct.
Wow. Okay. Brilliant. Okay. Well, let's move over to the numbers. You've obviously got a very full balance sheet and bank account there, Danny. I don't suppose you could just quickly take us through the financial highlights from the first half.
Yeah, no problem at all, Paul. So I'll just rattle through some of the headlines to begin with for the benefit of the audience, and then perhaps dive a bit more into detail of your questions afterwards. So as we've seen, group revenues went up 43% in the first half of this year to 15.4 million. On the pro forma basis, including the acquisition of Health and Her at the end of 2024, that growth was about 12.5%. So Health and Her contributed just over 4 million to first half revenues, and delivered 38% growth on a pro forma basis just from that part of the business. So really great to see that acquisition performing strongly, and I appreciate we'll probably talk about integration of that business later on. Gross profit went up on the back of that revenue growth, as you'd expect. So gross profit was up to 6.6 million in the first half, over 4.4 the previous year, and gross margin percentage improved as well. 43% GM in the first half of this year versus about 41% on a reported basis last year. So really that extra 2% is coming from the impact of the Health and Her acquisition. Those products are typically 10 to 12 percentage points higher from a gross margin standpoint than some of the other core brands of Venture Life Then from a marketing perspective, I think really important to emphasize again, we're doing a lot of investment in our marketing right now to drive the top line growth of those brands. And it doesn't surprise you that Health and Her growth of 38% from those brands, they are well supported by marketing, but look at the growth we're achieving as a result of it. So when we look at the group now, we're spending around 10% of our overall revenues back into marketing. But it's important to understand that there's some products within the group that do not get marketing support, such as the oncology support range. Also, our international partners, distributors, they do the marketing in local markets themselves. So if you just look at the brands that we support with marketing costs, our spend is around 14% of the revenues from those brands. And what we're seeing is a strong top line double-digit growth across the women's health business, the intimate health business, on the hormone health as well. So it's delivering a clear return. It's driving up gross margin in the business. Yes, we're spending more on our marketing to help deliver that, but ultimately what that's driving is raised brand awareness for us, increasing our rate of sellout in the business, helping us increase the distribution, bring more products into the brand portfolio of our retailers. So there is an element of lag effect, Paul, when you look at our EBITDA margins for the first half. They're down about a percentage point year on year, but that is very much driven by the fact we're investing more in marketing right now to raise that brand awareness. That will bring new people into the brand and ultimately drive higher revenues in the second half of this year and at higher margins, so the EBITDA benefit will come back. So overall, as we move forward, we expect in the short term to drive EBITDA margins up by about 2% as a result of the investment in marketing, driving 5% gross margin improvement over the next couple of years, and then taking the 3% of that into marketing, 2% net to EBITDA. So there's a lag effect piece to be aware of on that brand awareness, as it's a constant activity we're doing. I'll talk free cash flow for a second. So we reported free cash flow of 1.5 million for the first half of the year. That includes a significant outlay from exceptional cash costs. So as you know, Paul, we're implementing a new ERP system at the moment, Microsoft Dynamics. That's been going on since the end of last year. So it will complete and go live at 1st of December this year, I'm really pleased to say. It's been a really smooth implementation, but we spent around 700,000 of cash exceptionals in implementing that in just the first half of this year alone. So our free cash flow is really sort of pulled down by that cash exceptional, and on a normalised basis, underlying free cash flow was about in line with the first half of last year at 2.2 million. Touch base on cash, as that was the opener to this question. So at the end of June, in our numbers we've reported, we of course still had the debt facility, drawn funds against that. So with the divestment proceeds coming in July just gone, we paid down the RCF a couple of weeks later. So we had 65 million euros land in our account at the end of July. We paid down the debt in full of the drawn funds. So we're now sitting on a net cash position at end of September of about 34 million. We've, of course, got the facility still in place. So we've got access to 30 million initially on the RCF and a further 20 million accordion should we wish to trigger that. So effectively, we've got 84 million of firepower available to us for our M&A activities. And of course, we're working hard through that list at the moment to find the right opportunities at the right price.
Yeah. And just in terms of that marketing spend, is it all brand awareness and recognition, or is it also doing sort of like price discounting at all?
We're actually in a gradual shift right now, Paul. So historically, our marketing spend has probably been more weighted towards fixed spend, which is the in-store spend to have gate fees set up, run promotions in store, and also driven towards Amazon marketing. As you know, our Amazon business has grown from strength to strength over the last 4 years. But what we're starting to do now, especially with the new team and structure that Jerry's built within the marketing function, is put more focus onto digital marketing activities, where actually you're really putting through the sell-through and brand awareness on the consumer base that we're targeting. So really moving some of that spend to an area where we think we can get more impressions and access to potential newcomers to our brands, which will ultimately drive awareness and rate of sale and sellout. That's a huge level of focus to us right now. So we are on a shift right now. I would say that we're going to increase our overall mix of marketing spend. Has historically been about 15 to 20% on brand awareness and digital activity, upwards towards 40% of our overall marketing spend will be on those activities going forward.
Yeah. And then just as you grow into the US, are you seeing any impact at all from the tariffs, or is it not really a problem?
Well, of course, we've got the impact of it going from, say, we were paying about 6% prior to Liberation Day. So we pay 10% now on the cost of goods to supply that market. But there's a couple of things to highlight here. One is that on Amazon in the US, we were able to immediately push up our prices once that tariff was announced. So we were able to neutralize the impact from that. You've seen that we've launched into CVS really strongly in the first half of this year. That stock had actually already gone into the US before Liberation Day, so it wasn't impacted by the tariffs. And because we're only still in an ascent stage in launching into the US, our revenues in that market are about 1.5 million this year, against around 38 million that we expect to do overall. So the actual impact is very small on the business from that 6 to 10%. But more importantly, because of the timing of the announcement, we're able to manage it into our pricing negotiations as we win new business. So we've been doing that since April this year. We've added new customers into the US, and we've already been able to factor that into our pricing. So short answer to your question is no, we haven't had much impact, and we're not going to get much impact because we've been able to manage it.
Fantastic. And then just finally on that integration with Health and Her, are they now on your ERP system, the newly introduced one as well?
Yeah, absolutely. They were all parts of the project. So we knew they were coming on board when we were signing up to that program. So like the rest of the group, they will go live with everyone else on 1st of December this year, which is fantastic because that gives us ultimately a scalable platform, Paul, to acquire new businesses, acquire new assets, integrate them into that platform and be able to report on it quickly, get insights faster, and be able to make decisions quicker and more accurately than we have been in the past.
Brilliant. Okay, then Jerry, I know you've made an astute appointment as your sort of like head of M&A to to carefully invest the funds into all potential acquisitions. Just broadly, obviously, you can't say anything sort of commercially sensitive, but geographically, where are you thinking of, and in what sort of like particular areas, therapeutic areas?
Yeah, I mean, a big focus for us will be to look at the areas where we're already investing behind brands, so women's health and men's health. Probably looking into sort of functional sexual health as well, and maybe into sort of lower sort of UTIs and those sort of things. So that's where we're looking. That's sort of adjacent to various areas we are now in the same sort of categories. Geographically, we're looking at a number. Most of them are in the UK, but there are some in mainland Europe as well.
Okay, good. And then, Danny, I know you've announced a sort of quite a big stock buyback. Do you want to just walk us through that, and also the decision, obviously, to not put have a dividend yet?
Yeah, no problem, Paul. I mean, ultimately, I think Jerry, you're probably a better place to talk to the background on the market there.
Yeah,
but perhaps I can take on to the end of it. You're probably best placed.
Sure, yeah. I mean, when we obviously when we announced the divestment in May and then it completed in July, we had a lot of feedback from shareholders, particularly institutional shareholders, saying, what you can do with the money, you can give it back. I mean, as a board, we're clearly to view the best value for the shareholders for us to properly invest that to drive growth in our brands to some extent, but also to acquire some interesting brands with a profitable runway, which we think we can exploit through distribution, through MPD, and through our strategic customer relationships. So that's where we're going to deploy it. We do have a recognise, though, that currently our share price is incredibly low, and we're valued or rated at a value below what we would be looking to buy some of the assets that we're targeting in terms of multiple. So it makes a lot of sense for us to buy back stock at this level because it's cheaper in terms of ratings than some of the things we're going to be buying. So we've got an authority up to 10% of our shares, 12 million shares. At today's price, that's 7 million quid. I don't expect we're going to be using all of that, and that's just the upper limit. So really, from our perspective, while the shares are cheap, which they are, we think that's a good use of our capital, and we'll take that forward on that basis.
Yeah, certainly also for the stock buyback. You don't have to do much due diligence on those purchases, do you? Because
I think we know what we're buying.
Okay, and then just in terms of your organic growth, is there any of those funds which is going to be allocated to the organic growth, or is it all going to be self-funding? If you're doing it sort of like 12% pro forma top line growth and putting more marketing to existing business, is that all self-funding? And really, you've got all of that, 34 million essentially to invest in deals.
Yeah, sure. Danny, do you want to?
Yeah, so on the organic piece, so yes, to build on the point around the marketing costs earlier, Paul, appreciate that whilst we've got an ample amount of cash available to us right now, we can't just go and throw that all at the P&L. But it's certainly given us the ability to test things that we haven't been able to test before in terms of trialing new ways of doing our marketing, doing pilot trials, doing television campaigns that we've never done in the past. Kate's come in and joining the board later this year, already running these small pilot campaigns. We're seeing 5 times, 6 times revenue uplift on the back of these short campaigns, which have been run really cost effectively. And we did one in the US recently. I think it cost us $6,000 for a TV campaign, and it drove a 600% uplift on Amazon. So having the cash available to us, Paul, I would say, is giving us more confidence to try new things. But it's all about making sure we've got absolute conviction over where we can deploy that marketing cost and we're getting the greatest return. So we're doing a lot of focus right now on trialing the direct and immediate impact we're getting from these smaller investments and being able to then see which are most successful and deploy that across all of our brands.
Great. And then, Jerry, on terms of new products, anything on the slate at all for Christmas or for the next 6 months or so?
Well, there's quite a few here on the table in front of us.
I know, good.
Health and Him has got quite a prolific new product development pipeline here. Just launching like the contraception, the HRT product, pregnancy products out now as well. So there's a very deep pipeline on both Health and Him and Health and Her, which will be rolling out in the next couple of years. But we've now appointed Kate, who was one of the co-founders of Health and Her. She's now head of marketing and innovation. And she's now running the innovation pipeline across all our brands. And there's a tremendous amount of opportunity there, a lot of white space within those categories that we think we can attack. So plenty on the organic side, certainly for the next 2 or 3 years, really exciting. And we're engaging with retailers. We're having a strategic relationship with them. So Gervais, the other co-founder of Health and Her, is now in charge of strategic partner management. And that's involving getting in front of people like Holland & Barrett, understanding where they want their categories to go, helping them with insight and relevant research to build out the categories, and then obviously to place our products in there. So that's the real key role that Gervais is fulfilling and building across all of our brands. So yeah, plenty of NPD, plenty more to come out. And we just launched this September the prostate product, Prostagard, in Health and Her, which Health and Him, excuse me, in Holland & Barrett. So again, that's using some technology, some branding we have, and bringing that into the space. So you'll see that Health and Him build out more and more to sort of catch up with the Health and Her. Health and Him's only launched back end of last year.
Fantastic. Okay, then just in terms of the outlook there, Danny, I suppose you could take us, say a few words in terms of the Q3 trading and how you see the rest of the sort of like period until I think your new accounting period is May 2026.
Yeah, sure. I'll comment on the Q3 trading piece first, and perhaps touch base on the year-end change in a moment. So yeah, what we're seeing is in the UK, the consumer brands are continuing to grow strongly, and on the back of what we've just reported for the first half, we're seeing continuation of that and improvement on some of the brands, which is fantastic. And again, that comes back to the point earlier about that marketing cost increasing the rate of brand awareness and the sellout rate of our brands. In tandem with that, new product launches that we've achieved in H1 2025, continuing to get full half of that benefit in the second half of the year. So what we're seeing is our power brands in the UK continuing to grow strongly. And of course, on an international perspective, by this point in the year, we've got orders in hand from those partners. We know where those revenues will be for the parts of the business which we don't put the marketing costs behind. So if you just look at our first half, our revenues would have been at 75% of our revenues on our consumer brands in the UK, including the US launch into CVS Pharmacy. But when you look on a full year basis, because our international revenues are heavily weighted towards the second half, it goes down to around 65% on the consumer brands business and 35% on those international partners. But perhaps that leads me nicely into the year end point, is that with that second half waiting on our international partners historically, and also what's driving that ultimately is retailers restocking for the new calendar year. We see our biggest revenues historically in Q4 and mainly December, which is also the shortest month of the year from an operational perspective, because you've got a shorter month, you've got challenges about courier cost, transportation is more expensive, getting planning and holding than that. So we actually get a lot of efficiency out of changing the year end to May, because we can smooth out the seasonality pattern on our business and make it more 48-52 going forward, as opposed to sort of the 40-60 split we see today. So there's a lot of benefit in changing that year end and smoothing out the numbers.
What's the sort of visibility over that, as in terms of seeing those orders coming through from your distributors and also from the grocers or the supermarkets or the pharmacies or people like Holland?
Yeah, sure. I mean, typically from our international partners, they will give us 12-month rolling forecasts, which are indicative, and then they will place those purchase orders 3 months out prior to requiring the goods to be delivered. So by this point in the year, 1st of October, we've got the order book for the end of the year. So, but as we say, December's a shorter month, so making sure we fulfill all of that in time for the year end, it's just alleviated another pressure on the business to manage things better going forward. So, but then on the retail side of it, with a lot of focus in building and restructuring the commercial and marketing team over this year, there's so much more increased insight about the EPOS rate of sale on all of our products, managing that really closely, understanding the impacts of the promotional uplifts we're doing, because we are investing more into marketing and making sure we get the best returns on those. So we've got a lot of visibility of the run rate of the UK business, because those orders are placed by retailers every week or so, whereas on the international business, it's much more longer out in terms of placing the orders. But as we say, we've got visibility at this point in the year of the full year.
Yeah, well, we should have an exciting time, because I think there's Amazon Prime later this month, and then you have is it Thanksgiving and Cyber Monday, and then obviously Christmas. So that's really are be flying off the shelves. Okay, just in terms of some of the closing remarks there, Jerry. Obviously, you've now shaped the business such that you've got a war chest of money, and I guess really you haven't got to invest in much capex. It's a capital light business as well. Just overall, how you see this for messages for shareholders in the next sort of 12 months, 24 months?
Yeah, I mean, I think clearly the share price is significantly undervalued. We know the markets are where they are. So from an investor perspective, we're a really good buy. I think hopefully the markets will come back and liquidity will return at some point. But I think we've got significant resource now to scale this business. We've, fortunately at the moment, don't need to raise capital from the market, so we've got that ourselves. We've got great brands. They've got great trajectory. The marketing plans are working very well. We continue to invest and increase the A&P, so you're going to see that delivering better margins, good growth, market-beating growth, growing better than our peers, and some great acquisitions to fill in some of those white spaces within our category. So yeah, really exciting time. We've integrated the teams, like I said, they're all part of Venture Life now. Fantastic, good verticals, really good people, both from Health and Her coming into the business, but also from new recruits and new hires from outside. So yeah, I'm very excited about the business. I think we've got a great team, great runway ahead of us, some great white space to fill, and all the resources to do it. So yeah, we're very excited. Yeah.
Fabulous. And just a final question on Health and Her. Is it now profitable? Because I know you bought it and I think it was at break even or slightly loss making on a historical perspective, but now that you've got the integration and you're putting money in it and the top line is really motoring, is it?
Yeah, you're right. Well, you're right, Paul. When at the point we bought the business, historically it hadn't been making profit because it'd been investing to grow the brand, and clearly they've done a great job of that. Growing the business up 38% in the first half of this year. But maintaining sort of the percentage level investment that was there before. So this year, although the business was break even historically, we're going to see around 400-500k in profit from the business this year. So it's becoming meaningfully additional to the EBITDA of the group.
Fantastic acquisition. Well, happy days. So hope you have a really good Christmas over the next 2 or 3 months, and very much looking forward in touching base on a lot of corporate developments going forward. So thanks again, gents, and congrats on the very strong first half results.
Right. Thanks, Paul.
Thank you, Paul.